The reason why you're failing as a trader isn't because you haven't mastered your strategy. It's because you're struggling to understand when you should be swing trading and holding your positions and when you should be scalping and getting in and out of the market. Because the market's conditions are one of the biggest factors that determine whether someone is profitable, whether they can wait for good probability conditions to actually execute on their trades. People struggle to determine when they should lower their risk and hold their positions for a longer period of time if the market's moving really volatile, and other times when they should be scalping when the market is inside of a tight bound range and they should just hop in and out of the market with a higher lot size but getting out quicker. You shouldn't limit yourself to just one of these styles of trading. Scalping and swing trading should be something that you adapt based on the market conditions. And in this video, I'm going to help you better understand scalping. Just like scalping, I'm going to make an entire video just like this one on an ultimate guide to swing trading. But this video is specifically focused on helping you understand scalping and how you apply scalping in a lower time frame and a higher volatility environment in a tight bound range. I'm going to show you exactly what kind of trading conditions I personally decide to scalp in, how I leverage in with my risk, and what I typically aim for before I get out of my positions when I'm scalping. I'm going to show you exactly how you can scale up your live accounts and also get payouts consistently using your funded accounts just from scalping. Now, as I mentioned, as a trader, you should not be limiting yourself to just one of these styles of trading, scalping or swing trading. You should learn to adapt it. But after you fully watch this video, you can simply choose not to learn how to swing trade and just wait for the specific conditions that you can scalp in. Because one of the best ways of actually keeping the money that you make from trading is simply not trading at all. You should be able to understand that the market is unpredictable some days, or there's simply some economic news that's going to prevent you from catching any good trades. I'm also going to show you something that I might have given you a misunderstanding about. When I say tight bound range, I'm not talking about consolidation. You should not be scalping inside of consolidation. I'm going to specifically show you what a tight bound range that is tradable and what a tight bound range that isn't tradable looks like, and how you could specifically scalp inside of a tradable tight bound range. Without further ado, let's hop into this video. My name is Marky and I upload 2 times per week on this channel. If you want to get more educational videos just like this one on ultimate guides either to fair rally gaps, to creating a profitable system, scalping, swing trading, or even flipping small accounts, I'm going to be teaching you everything that I've learned over the years that I've been trading. So without further ado, let's hop straight into the video. Okay, so the first thing I want to show you is premium and discount. You probably are already familiar with premium and discount, but it never hurts to review. Whenever there's a move, especially if you're trending buy side, and you see the market create a swing low, it's clear that this is the low that it was running up from, and it creates a high and then starts to pull back. Inside of this range, you know that this right here is the main impulse move, especially if you're expecting price to later continue towards buy side. You're going to want to make sure that your scalps are not coming from the premium, because this is going to lower your accuracy by a lot. You want to always make sure that you're taking the 0.5 of every single swing high like this and making sure that your scalps are always in the discount. That's the least you can do to increase your win rate by a lot, because seriously, if you're going to try to catch buys from the premium, you're going to get a lot of random wicks that are going to wick down lower, potentially trying to draw into this 0.5, and you're just going to take a lot of unnecessary losses while you're trying to scalp for longs in a continuation move. Let's take a look at some live price action examples of a premium and discount inside of a move. Okay, so first things first, we want to find the higher time frame narrative that is running towards. If the higher time frame narrative is buy side, then you're going to mark it out from the swing low. Like I said, it's going to be clear that this is the low. There's a swing low right here. And once it starts running up, it's going to be clear that it stops at some level to pull back down. When it stops at some level, you're measuring the move to find out the discount, and you're going to want to make sure that your scalps come into this discount. You're not going to be aiming to hold for the entire continuation. You just want to make sure that you're trading from the discount, because this is where your trades are going to have a higher probability. So be sure you never exclude the premium and discount in every single range that you're trading, because when you're scalping, you want to make sure that you're trading only A+ setups, and A+ setups involve everything to align with your bias. And maybe sometimes it doesn't even draw to the discount. You should still always wait, because you're scalping and you're going to have a tight stop loss. So if you want to avoid those losses, just make sure you're waiting for price to come into the premium if you're selling and into the discount if you're buying. Let's take a look at some more premium and discount ranges so you can get a better idea of how you actually mark out the high and the low of the Fibonacci tool, some other Fibonacci tools that you can use to measure the premium and discount, and then we can actually hop in on the lower time frame and see potential scalps that we could have taken inside of this level. So let's keep scrolling and just kind of identify. This would be another swing low to a swing high, except price didn't actually start pulling back down. So you just simply would wait for it to actually pull down. You're not trading until it comes down to a discount. In a one-sided direction like this, obviously you're not going to be waiting for huge 4-hour swing highs for it to come into the discount of those specific swing highs. And maybe on the lower time frame, you'd actually be able to find some premium and discounts. But essentially, whenever you do have a huge pullback like this, it's really high probability for you to scalp inside of this specific leg. So let's hop into the discount inside of this price leg and see the kind of trades that we would have been able to take once price did dip down into this discount. So first things first, also mark out the fact that we have some liquidity right there, which is going to be significant for us. Let's watch price dip down into the discount. Okay, there you go. Swept the discount, started consolidating a little bit. And now during the next session, we are actually moving up. So if you're scalping, you're not looking for anything crazy. You're not looking for the perfect entry. What you're looking for is literally a simple low to high. And these just involve a fair value gap getting filled just like this right here. If you know that price is now going to run on buy side because you're bullish, and you see something like this where a fair value gap gets filled, it's not going to go fast like it was for me. You're going to see it slowly fill a fair value gap. And once you see that happen, you hop into your trade and you literally target the nearest high. Just like this, you'd optimally get somewhere in near the midpoint. My stop loss is always really tight on funded accounts that I'm scalping with, or a live account that I'm going high risk on, and we're just aiming for the nearest high to get swept. That's all that scalping basically is. And if you see another fair value gap get swept like this after it runs from another one, same exact concept. You look at the gap, you try to enter somewhere near the midpoint of this gap. You secure your stop loss. Maybe this one would be a little less high probability because there's a gap lower. But once again, you're simply aiming for the high. The high here isn't too far away, so we can add a few pips to the TP. And once again, you're just looking for the high to get taken out there. It's consolidating. We just honestly end the trade early if that's the case. Once again, we can scale back out, see what's going on the higher time frame. 30-minute time frame. Okay, this trade also involved a 30-minute fair value gap that got filled up. Another potential entry for you. You're just looking for scalp positions. We got an IFEG right here. So we know that price is likely going to start expanding towards buy side once again, since it is consolidating and respecting this IFEG. So we scale down again, and we know it's going to run. So what are we looking for? We're looking for some liquidity sweep before a move that runs towards buy side. Another confluence I really like using are inverse fair value gaps, just like the one that I was showing you on the higher time frame. We wait for price to leave this little range, close above right there. If it taps back into this IFEG, we hop into a trade. Okay, that might have been a good little entry right there off the liquidity sweep, because this right here is also a fair value gap that got filled, plus a liquidity sweep. Let's see if this ran into the discount of this range as well. It did tap into the discount, so that would have been another really good scalp. Let's see if this one would hit. We can secure our stop loss below the IFEG right there, and we just target the high. That's it. You're looking for 20-30 pip moves. Sometimes 20-30 pips is generous, and you can hop out earlier if the trade allows it. This move was pretty big. It was from 3543, you can see on the right here, 3543 to 3550. So that's about 70 pips sweeping the high. You're just scalping, you're in and out of the market. You're using a higher lot size, and you're usually trying to get as tight of a stop loss as possible. You're trying to trade every range from the 0.5. We already are in the 0.5 in the 4-hour time frame. As I mentioned, we are running from the 0.5, and we're just looking for scalp positions towards the narrative that we're aiming for. So once again, make sure you're always including the premium and discount. And I hope you have a little bit of a better idea of how you can involve the premium and discount, specifically on the lower time frame as well, to just catch higher probability entries, to see if even if it misses like an IFEG, you can still enter longs anyways because it's in the discount and it's still a high probability position. The second thing when it comes to scalping is liquidity. So you're going to want to keep a really close and attentive eye to liquidity and consolidation, because you want to be able to trade these kind of moves in between when the liquidity is getting swept on both sides. Manipulation is a scalper's best friend. While normally I wouldn't be trading manipulation, when I scalp and I'm looking for very tight trades, sometimes inside of a higher time frame consolidation, That's what I'd call a tight bound range, where it's still running a decent amount, like in between 50, 60, 70 pips, but it's consolidating on that higher time frame. But if you're looking for scalps on the lower time frame, you're still able to get your 20 pips. You're still able to get in and out of the market with a high probability entry. So here I'm going to show you how you would be able to look at liquidity. Here we have some consolidation. This isn't even a higher time frame consolidation. This is a lower time frame consolidation. But I'm just trying to show you what liquidity is and how you can literally aim for it, just like this. So if you're looking for a trade, for example, you're trying to take out this liquidity, all you do inside of a range like this is you wait for it to take out liquidity and start moving up. You see an order block form like bearish candles that come up above it, and you are able to hop in targeting this next liquidity because you know it's consolidating inside of this tight bound range, and it was building up a whole lot of liquidity for you to come and take out. Here's another sweep that we got right there. And this high is a shallow sweep where we ended up reversing and sweeping out the low. So once you see this form right here and you were to get a IFEG just like we got right here, super tiny IFEG, but we came up after sweeping this low, created an IFEG, and from there you could have taken another entry once again just to the high. That's all we're aiming for is liquidity. We're aiming for liquidity to liquidity. And the next thing I'm going to show you is going to blow your mind. It's something that I learned a while ago called macros. And it's specific times that you are looking for these sweeps of highs or lows. And it's going to definitely level up your game. You're going to see the algorithm move more clearly than you've ever seen before. But before I show you that, let me show you what I mean by a tight bound range that's actually tradable. So let's scale out to the weekly time frame and see literally what's been going on for the last few weeks. We've been consolidating inside of this specific area right here until we left in the last 2 weeks, right? We've been consolidating inside of this area. This right here is consolidation, and nobody wants to trade consolidation. However, when you're scalping, this kind of consolidation is not bad for you at all. Got a liquidity sweep right here. You can hop inside of the lower time frame and look for trades towards sell side. It starts moving back up from the lower bound of the consolidation. So you hop in and you look for long position scalps. This looks like consolidation that's very deadly, but on the lower time frame, there's so much volatility and movement. For a scalper, this is a perfect range where you know it's likely just going to keep reversing for a while until we get a move like this that actually leaves the range clearly. The next thing that you're going to need to know as a scalper is managing your time frames properly. And how do you know which time frame to use? This obviously is going to depend on the context of every trade. Like for this trade here, you know that there's a daily gap. We're not always trading from a daily gap, but today we were trading from a daily gap. On the lower time frame, 4 hour, this daily gap aligns perfectly with the 4 hour gap. So same as like the example I kind of used earlier, you mark out the premium and discount, and then you hop in and just figure out where the gaps are. So what I'm trying to tell you is, how do you know what time frame to use? Gaps, 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 gaps. You heard me say it 5 times right there. Gaps will determine which time frame you are going to be trading on, because there's only going to be a gap to some certain time frame. There's not going to be a gap all over the place. First of all, like right here, we only have a certain set of gaps, like one gap right here. So you know that this is the 30-minute time frame, one gap right there. The next 30-minute gap is down here. So there's only so much gaps that you can actually trade from. Here would be another perfect scalp, and I actually took this trade today because on the 4 hour time frame, in this moment right here, there was no wick on the 4 hour candle. So this is the open of the 4 hour candle, and there was no wick on this candle. So when this candle came down and tapped into this, I knew that we were going to come up and at least rebalance this, like make sure that there was a wick on the 4 hour candle. Like if we look at the 4 hour time frame right now, there's a wick on it now. It's bullish candle, right? But previously right here, it was a bearish candle with no wick. Because I saw the reaction on this 30-minute fair value gap, I was able to hop in and simply target this candle that had no wick. That's an inefficiency. And just like that, I had a 3536 to 3546 100 pip move. That's a scalp that paid me nicely, and it's going to pay you heavily if you are able to find little inefficiencies like this and take advantage of them when they present themselves in the market. For those of you that don't know how to trade gaps at all, or what gaps even are, let me show you. Gaps involve 3 candles. You're going to want to measure 3 candles. 1, 2, 3 candles. And it's the intersection between the wicks on the 3 candles. So 1, 2, 3 candles. And if there's an intersection between the wick of the bottom candle and the wick of the top candle, then there is a gap that forms between them. Just like that. Right here, there's another gap right here. We got 1, 2, 3. The wicks of these candles don't overlap, and therefore there is a gap in between them. Let me show you an example where there is no gap. You got 1, 2, 3, but you can see that the wicks overlap on this candle right here. So there is no gap, right? They overlap. Let me show you again the examples that I just marked out. 1, 2, 3, and the wicks don't overlap, therefore forming a fair value gap in between them. Right here, once again, 1, 2, 3, but the wicks overlap and there is no fair value gap right there. So that's pretty much it. Same with the buy side. Let's look at a bullish example. We got 1, 2, 3. The wicks of these 3 candles don't overlap and therefore we have a fair value gap in between. You can see that the market came, filled this up, and then continued higher. That's how fair value gaps work. Let me show you a bullish example now that does not have a fair value gap. We got 1, 2, 3, but the wicks right here overlap. You can see that this one pulled down, overlapped, and therefore did not allow a new fair value gap to be created. That's how fair value gaps work. And understanding these gaps will help you understand which time frame you are going to be scalping on and looking for a trade in the lower time frames on. Now, I want to give you an FYI that so far, every single one of these examples that I've showed you so far has been on gold. But I want you to know that this isn't something that only shows up on gold. In fact, it shows up on every market. So I'm going to show you that every single one of the concepts that I've showed you so far shows up on gold and on every other market that you're probably going to be trading if you're looking to take trades as a day trader, especially scalp setups. What pairs are good for scalping? What pairs aren't good for scalping? So first of all, let's hop in. I'm just going to start from the monthly time frame. It makes no difference whether you're on the monthly, the weekly. In fact, the higher the time frame, the more relevant the narrative is. So if you find a gap like this getting filled on the monthly time frame, then you're going to know that it's going to be moving up in the long run of that month. You saw that here we filled up the majority of this gap almost fully, and then from then on we ran like crazy. And like realistically, we don't run into monthly gaps often. And so whenever we do run into a monthly gap, let's find another example. Here's another example. 2 times did we run into this gap and got some explosive movement from it. Right here, we ran into this gap the first time, this month closed, then the next month opened and expanded. We came back into it again in this month, it tapped into it and exploded. And from then on, obviously ran so much higher, right? So you're going to want to be paying attention to the really high time frame gaps. Same with the weekly time frame, which happens a little more frequently, where we tap into weekly gaps. Remember, gaps don't exist everywhere. And one of the things you can do is you can use one of these FVG Nephew Sam indicators to show you the gaps, right? I just marked out a gap and it'll mark out all the gaps. You can literally just look through your charts and see where we tapped into these gaps, right? And it won't show the ones that have been disrespected, even though IFVGs are significant. So that's a completely different concept from FVGs. It's a disrespected FVG. So it just flips the narrative around. But once again, kind of want to show you that all these gaps, they get tapped into, respected, and market moves up from them. So your objective is to find these kind of gaps. Here on the weekly time frame, we tapped into it, continued higher. Another weekly gap formed, tapped into it, ran higher. Here we're getting a new one finally after leaving this entire range. So I'm just showing you the weekly time frame, and you're seeing that these high time frames are revolving around gaps. So it's something really significant for you to use in general. Now let's hop on NASDAQ. So once again, what pairs are good to trade scalps on, and which pairs aren't good to scalp on? First of all, let me tell you the differences between trading gold and trading NASDAQ. NASDAQ will not be moving like gold at all. NASDAQ is a completely different field to trade in completely, because gold typically moves during every session. So you can generally start trading during Asia session like me when the new daily candle opens and it's going to expand. NASDAQ, on the other hand, is mainly a New York session based pair. It's a US pair, right? It's a stock from the US, so it's going to be moving during New York session, which is the US session. London session typically moves the euro or the Great British pound. Asia typically moves Japanese yen and any other Asian currencies, right? So during the NASDAQ during these times is not going to be moving. So when you're scalping in NASDAQ, you're going to want to be trading it during New York session. And it's going to move completely different than gold is, for example. Because gold, when you scalp, you can also hold your scalp positions. Like if you get a good scalp, you exit at the high, and you can hold the rest of your position. And that's one of the main reasons why I'm trading gold, because you can take a trade during Asia in the start of the day, somewhere inside of this gap, for example. Start of the day, new daily candle expands, and you hold the position in the long run if you catch that scalp. NASDAQ, you actually have to scalp. You have to close your scalps as well. This is in, out, and you're done for the day, because you know that the next day is going to come around and it's going to do something crazy. So NASDAQ's super volatile, completely different from trading gold, but that doesn't mean gold isn't moving during New York. Gold moves during New York too. This is NFP day, so obviously we had a lot of volatility on every single USD pair, but you can see that gold also moves during New York session as well. It's just the fact that NQ is going to be super volatile. Meanwhile, if gold has already hit its daily target, like Asia session runs and all the volatility happens during Asia session, then New York session might be weak, just like this one. We just literally consolidated until the day closed. New day opened. Once again, we ran during Asia session, pulled back during London, and did the same move during New York. So it really just depends on catching the characteristic of the pair. If the move happens, like the daily range only has a set target every single day. Once that target is hit, whether it happens during Asia, whether it happens during London, typically it can just stop moving and consolidate until the day closes, and you'll see that happen. So you want to make sure that you can clearly identify, using the higher time frames, where it's going to draw to. If it's Friday, you know the market's going to close. So go to the weekly time frame and figure out, okay, it's Friday, the week is coming to an end. Go to the weekly time frame and try to identify, is there a gap that is trying to close into? If the market's at all-time highs, then obviously there's not really much of a target for you to aim for on Friday. But for example, the market is let's say right here inside of this candle, and on Friday you can see we closed right here. So if the market's like somewhere up here on Friday, and you know that it wants to close somewhere closer to the gap, because it's always drawing to these gaps. These gaps are like magnets. It's pulling price down towards these magnets. So you see that it's up here right now on Friday. You know it's going to likely draw down there. So on Friday, you have a bearish narrative for your scalps. You're going to be scalping towards sell side. And that's how you kind of determine, okay, where's the daily candle going to go on Friday? So let's take a look at this range on Friday. Boom. Daily candle. I went to the previous week. So here we got Monday. Here we got Tuesday, Wednesday, Thursday, Friday. Boom. So you can see Friday opened. We obviously wanted to draw down into that weekly gap, and so we tapped into it, and we had a bearish day. So that's how you kind of like formulate your narrative around the weekly time frame if it's Friday, and you use that for your scalps. If it's Thursday, and you know, okay, Thursday, we're still up here. We haven't ran to the weekly yet. We're probably going to be bearish on Thursday as well. Thursday's range ran down almost to there, but it didn't necessarily hit the target. There's still one more day. The week's not over. You can be like, okay, we hit something. We took out a low on Thursday. It's probably done trading, and it will consolidate until the day closes. You kind of want to know when it's consolidating, when the move has already finished, and that's when you stop trading. If it already hit the weekly target, for example, right here on Friday, you close your position and you're like, okay, I'm done, because it already hit the weekly target. It's probably going to stop moving and consolidating. When you're scalping, consolidation is your worst enemy. Like lower time frame consolidation is one of your worst enemies when you're scalping, because let's say you have a bearish narrative, but it's going to randomly go up because it's staying inside of the range. So there's still going to be buy side. And then that buy side is going to trick you. It's going to, oh, we're sweeping out highs. We're probably going to run higher. And then it goes back down. And genuinely, scalping consolidation is super difficult. It's going to mess you up. This isn't like the kind of consolidation that I'm talking about where it's in a tie-bound range. As I mentioned, tie-bound range is like weekly time frame stuff. So once again, let's look at NASDAQ. NASDAQ obviously respects the gaps just as much. Take a look at the weekly time frame. We can see this literal gap has been respected a bajillion times. 1, 2, and none of these candles have closed below it yet. So that's kind of crazy. Here's another weekly gap. We tapped into it, ran up higher from it. This is the inversion for value gap that I mentioned earlier. It's a bearish gap that gets disrespected. So obviously we want to run down from this gap, but instead we closed above it, using it to go higher instead. So that's an inversion for value gap. We're obviously going to be moving higher from those. Here's another gap that got respected a bajillion times and then it ran up from it. So potentially this might be what we're looking at here as well. We're respecting it and we obviously run up. But this also has to do with the dollar. So when you're scalping, you want to make sure that one of the things, it's going to be super complex, but if you're scalping, you're going to want to make sure that the dollar and gold, if you're trading gold, or like NASDAQ moves in the same direction as the dollar, I believe. And then gold moves against the dollar. So if you're trading gold and the dollar and the gold are both rising, something is wrong and you gotta stop because you want to make sure that there's nothing abnormal going on economically. If you're trading against the dollar, you want to literally trade against the dollar. So the dollar is moving in the opposite direction of gold, that's good for you. If it's moving in the same direction, you might get some consolidation because it's unclear of what the direction is. And so it's going to start consolidating. I've seen that happen over and over again. But that's something for you to personally watch out for. I'm not going to give you an exact lecture because I'm not sure of the exact correlation between it. This is just an observation that I've made, and I stopped trading during times where the dollar and gold are both moving in the same direction. Just not something that you want to do. Okay, let's hop on even Bitcoin. You'll see that Bitcoin also respects gaps. Gaps are typically just respected, and using this indicator, once again, let me show you the indicator. It's called FVG by Nephew Sam. You'll start to see, and like I used to use this indicator when I was starting off because it was just hard for me to see with my eyes on the blank charts where the fair value gaps were at. You're obviously not going to be using every single fair value gap. This will start showing you exactly which fair value gaps are relevant to use, or at least just like help you start seeing all of them, because like I said, it's 3 candle ranges. It's not going to mark out where there are no fair value gaps. Like right here, you see there's no fair value gap right here. Even though there's 3 candle ranges, you see that both of these wicks completely overlap each other. Like this one already ran up hella, this one ran up hella, or ran down hella. So it overlapped and therefore there was no gap right there. Very simple, and you're gonna be able to understand it and actually see them using this indicator. Eventually I want you guys to stop using this indicator because you're gonna want to train your eye and like actually learn the fundamentals of which ones you should be using and which ones you shouldn't be using. And then this indicator obviously won't be showing you IFEGs, which is a concept that you're gonna want to learn as well. So one of the things that I'm going to have you guys do for order blocks is also use another Nephew Sam indicator. So order blocks also have an indicator by Nephew Sam, which are very convenient. And you'll see on the chart that whenever they form, they'll pop up at the low or the high of the move. I'm not actually seeing them pop up. Maybe this indicator isn't showing up right now. There you go. So you see order blocks form once the high gets taken of the range, and it's the very lowest candle from the high to the low of the lowest candle in an order block range. That's the low of the move. So when you're going to be scalping, you want to consider order blocks because fair value gaps, they exist, yes. They're going to be telling you this narrative on the higher time frame. They're also going to give you confluence for entry on the lower time frame. But when you scale down all the way to the 1 minute and you're trying to place a super precise entry, like for example, you're trading funded accounts. You're trading your accounts and you want to have a super tight stop loss. Order blocks are going to give you a super tight stop loss because if you take a trade off of order blocks, you can genuinely secure your stop loss right below the low of the order block. So inside of this specific daily range, what we are looking for, which I deleted, is the daily gap. There's like some daily gap right here. It's a daily bearish gap that is yet to be tapped. We got a whole bunch of highs here. So before we start taking longs towards this and scalp trades in order to get to our daily target, let me teach you another concept that you need to know. And these are called macros. Macros are 10-minute period or 20-minute periods where inside of these 20-minute periods, you're going to mark them out like this from the ... 50 to the ... 10 of every hour. So it's the last 10 minutes to the first 10 minutes of every single hour. So if it's 11:50, it's from 11:50 to 12:10. That's the macro. It's a 20-minute period, and inside of this period, this is when you're looking for the algorithm to start moving towards highs or lows. So if there's accumulated highs and lows right here, when the macro starts, you're looking for it to either sweep the low or the high. So let's say the macro starts right here, you're looking for it to take out the low, and you're going to take longs towards the nearest high. That's how macros work. Super simple. Manipulation macro, from the lows to the high. Okay, so that's what you're looking for. That's what you're going to be using for your trades. And I'm going to show you inside of the charts on the 1 minute time frame how you're going to use macros to add confluence to your trade. Because we know about sessions, first of all. We know about kill zones, like the first opening hour of every session. But sometimes we're missing an extra component if our setup happens later. Or if we're trading scalps, then we're looking for an A+ setup. Maybe earlier into the session it wasn't in a discount, but later it's in the discount and we're looking for a trade. How do you know what time to execute? You know if it's inside of a macro and you get a liquidity sweep. This doesn't mean that every macro is going to get this perfect liquidity sweep of a low and high, but if you see that it happens inside of the macro, then it's going to be super high probability for you to take the trade. So we're going to be looking for some macros inside of this specific Asia range to target the daily level that's right here. And I'll show you guys after. I just know that because I'm in replay mode, if I go to the daily time frame, it's going to print the daily candle and you're going to see exactly where it ends up going. But okay, let's start looking for this daily range. Let's start looking for some macros. So we're going to scale down to the lower time frame and start looking. Okay, what time is it? It's about 11 p.m. We're already we should already be in London session actually if it's already 11 p.m. Okay, 11:30. Let's wait till 11:50. Let's mark out the highs and lows. So we're obviously running to the lows here. Let's wait for 11:50. Boom. So 11:50 is about to hit. We just took out the low, but we are much lower than the low. Typically the macros are a very shallow sweep. Let's look at the previous hour. Yeah, so right here you can see this is exactly what I mean by a macro, where we have the macro open 10:50. We have a shallow sweep of like the low. Right here we had a swing low, and all we did is we would take an entry from the nearest low that got swept inside the macro to the high. That's it. We take a 10-20 pip trade with a 10-20 pip TP or SL. So just like that, we have 10:50 to 11:10. And inside of the macro, we swept the low and we ran to the high. Let's look at another macro just for funsies. Okay, here we have another macro. Inside of the macro, when we started, 9:50. We did take out a low here. We didn't end up running on the high until we had a deeper. So this was a harder macro definitely to trade. We still did get a manipulation of sell side and buy side, but this wasn't the most perfect macro, just like this one was. Let's look at one more before we look at the current one. Here, 8:50, perfect. This is a perfect macro. 8:50, you can see that as soon as it hits, it ends up running on a low right here inside of the macro, and then we run on the nearest high. Bang, beautiful execution. Macro ends, you're done with the trade. Or if you were looking for sells instead, then once this macro swept the high, you enter shorts and you catch the same exact trade but towards sell side. So boom. And like I said, it's usually a very shallow sweep, so it's going to sweep just barely and then turn around. Those are the kind of macros that you're aiming to trade. So this one is a little frightening because it's obviously sweeping the low massively, but we do have a bullish target. So let's see if we do turn around here. Okay, we are turning around. Let's either look for an order block, let's look for an inversion fair value gap, or a new fair value gap. So here's the current bearish fair value gap. We want to see this thing disrespected if we're looking for longs. Okay, we're staying inside of it. Let's make sure we're watching the macro to see when the macro is ending, and we can no longer be looking for a trade like that. Here we just swept out the lows inside of a macro. If we're looking for a scalp for longs, this would be a great entry, not gonna lie. Even though we respected the bearish gap, we have a nice stop loss because we have a swing low right here. We just took out some lows, Let's just slightly aim higher than the highs here and trade inside of this macro for a scalp. This is all we're looking for. Remember, our scalp trades are super precise. We have a tight stop loss and we're using a good risk management. So one of the biggest things when you're taking a trade is not to overthink it, not to be afraid of taking the trade. Because when you're scalping, you're not swing trading. You're not trying to catch one trade and hold it for a while. When you're swing trading, you want to have a really good stop loss and just never worry about the trade because you're trading with the trend. You have a really high time frame support, you have a big stop loss, and you're not risking that much. Maybe like 2% on a swing trade that you're going to hold for a week. Like, that's not bad. On a scalp, you're not going to be risking 2%. You're not going to be risking 2,000. On a scalp, you're going to be risking 250 bucks, 300 bucks, maybe 500 or 800 at most. On a scalp, you want to have the best risk management so that you're not afraid of taking the trade. Whenever the confluence and the trade presents itself, you take the trade with a good risk management and you aren't afraid of taking it. If it's inside of the macro, it does what you want to see, why not take the trade? So I'm not sure how this will play out. Let's see here. Okay, we took a loss here. Let's say minus 300 bucks. We're going to be trading 300 bucks SL and we're going to be aiming for 800 bucks TP. Okay, so every time we're going to be taking a 1-2 or 1-3 RR trade, 900, 3 RR trade. There you go. So right here we're going to be taking 3 RR just so I can show you in the long run we're going to be profitable trading scalps like this as long as we know where the bias is. So once again, we swept out the low. Now we're going to take the trade one more time towards the longs. Once again, we're taking a 1-2-3 RR. There you go, 3 RR. We have our stop loss set in place. Once we take out this high, we're also going to have an order block. So let's just wait for us to take out the high. There you go. So we have an order block now. Let's get in right here before we tap the order block. Secure a stop loss below the order block at 300 bucks and go for a 3 RR trade. There you go. Here's another scalp trade. Let's see if we tap the order block. We don't tap the order block. And let's see if we get the trade. Because we are bullish, remember. So while this does look like a pretty big trade, we have the right narrative. And honestly, we're at about 2 RR on this trade right here. We can close out 600 bucks just because it's kind of moving sideways. Okay, so we did end up hitting our TP anyways. And that was a pretty solid trade. Remember, inside of the macro, we can get out at the highs. If we were only getting out at the highs here, boom, that would have been another scalp 1-1. You make your 300 bucks back, right? But obviously we took a loss first, so holding your trade might have been a good way to make up your loss. So here we would have gotten $800 from the market. And let's look for our next setup. So we still have yet to run on the highs here, and right above the high is that daily bullish gap that we were looking for. And the day's not over. We're barely about to run into London session. So what are we looking for? We're looking for any swing high. We're looking for the discount. We're looking for order blocks. We're looking for FVGs to be respected. Once again, we're respecting this FVG. We've respected it a few times. Let's go in a long right here. Secure a stop loss below the order block and target the highs. This is going to be 1-2 RR trade. Let me actually just start trading it. I believe 50 bucks is going to be good for how much risk we're using. Okay, perfect. So 200 bucks TP, 300 bucks, or 200 bucks SL, 300 bucks TP, just at the highs. We're respecting we got an order block for defense, okay? We're acting like this is battle. We're going into battle. We got our defense laid out. We have our attack troops ready. And we're going to attack the enemy base here, which is going to be the highs. We know that overall we're looking to take over the base up here. So this is a small base that we're taking out in order to get to the big base. Let's see if we get it here. Okay, respecting the gap. Let's see, we might just want to tap into this order block. And bang. Bang! Up 300 bucks on the day. Let's go. So you see what I mean though? If we know that the overall narrative, the overall target is going to be buy side. By the way, this might have happened during 150. Yeah, 150 is when this macro started. We literally just ran on the highs right away. So that was beautiful. Now that London session started, once again, we're looking for longs. We're looking for these highs up here to get taken out. All these accumulated highs, and right above it, we're looking to run into that bullish gap. So we're just looking for little scalps. Let's look at this next swing high right here. So here we have another swing high. Okay, another swing high just got created. Boom. Let's see if we run into the discount. We do run into the discount, but we don't have any gaps here. We have a gap all the way down here. Let's see if we tap into that one. Okay, so we didn't exactly tap into it the way that I had hoped. But here we have new gaps. So we have a bearish gap right here, and we have one right here. So if we're bullish, we just ran from an order block. While the indicator didn't mark this out as an order block, this is an order block. This is indeed an order block right here. It's a bearish candle. We ran up above the bearish candle. We tapped into it. Now we're getting an inversion for value gap, right? Let's look at the time as well. We got 250 just about around the corner. So we got 250 right here to 310. We just created an IFEG. Let's wait for it to tap in with the next one. There you go. We tapped into it. There you go. Why would we be afraid to take the entry when we have an order block? We have some built up highs and we have a target higher. So let's go for another 1 to 2 RR right here. Buy. SL about 200. TP about 300. 400. There you go. And back into the order block. Okay, we ended up taking a loss there. $200. We're still up on the day because of our first trade. Are we gonna run into the discount of the next move? Remember, when you're scalping, you can take a few trades because at the end of the day, you're scalping towards your bias. You set a TP for the day. Let's say $1,000 is what we're aiming for. We're in the discount now. Let's wait for it to start turning around because we are patient as scalpers. Wait for it to turn around. We do still have some nice highs right there. Okay, we're turning around from the discount. We just got a IFEG right here. We got an IFEG right here. Let's wait for it to tap in. There you go. We tapped into both of them. Let's hop into our trade right here. Once again, stop loss below the low and target the highs from the discount. Okay, enter the position. And going for about 500 here. Another IFEG. And there you go. As long as you're trading with the trend, you got some nice liquidity built up, and you trade when there is an order block, like as I mentioned, with a fair value gap from the discount, you will usually get your TP. So there you go. I'm not going to bore you guys with some back testing, but that's typically what goes into it. Is you just scale down from the higher time frame, you find the highest time frame with a narrative, and then on the lower time frame, you're just looking for all the previous concepts that I mentioned. You involve macros, you involve order blocks, you involve fair value gaps, you involve mainly the premium and discount. Because think about it, when you're trading with the trend, you're aiming for a higher time frame narrative. You know it's going to run up on buy side because today we have a bullish gap up there, right? It's Monday. We're going to start the weekly range by running towards the target in the week. So all you're doing on the lower time frame is you're waiting for a move to pull back into the discount, give you a little correction, and you trade that little correction to continue towards the trend. So let me go to the daily time frame and show you exactly what I was talking about. I'm gonna clear these up. There you go. You see this? So this right here is the bearish gap that has yet to be tapped into after we're running from a bullish gap down here. So obviously we're bullish. Inside of Monday's range, we're looking for it to expand towards buy side. So Monday's range closed bullish. You see that? So the entire Monday's range, we had a bullish narrative. Coming into Tuesday, we would have also had a bullish narrative. let's see Tuesday's candle. There you go. So you see Tuesday's candle opened up bullish. You would have been able to catch a bunch of longs inside of Tuesday's range, aiming for that same bearish gap on the daily time frame that we were aiming for on Monday, until it gets disrespected, until it gets filled up, right? Because on the weekly time frame, we're running from a weekly bullish gap. We're targeting a bearish gap on the daily that has yet to be tapped. That's how we found our bias. We hopped into the lower time frames and we looked for entry criteria that we premium discount, order blocks, fair value gaps. That's how you're supposed to be scalping. So this video's reaching about the limits. I can go into some more depth in terms of, I guess, inversion for value gaps, macros, and for value gaps. So the rest of this video, I'm going to be going into depth on how you can better understand premium discount, how you can trade the Fibonacci, how you can use projection tool. So let's hop straight into that. First things first, projection tool. Obviously, the premium and the discount doesn't just involve the 0.5. There's specific zones that are known as the golden zones, and ICT also teaches one of these called the optimal trade entry. And this is also just a widely known Fibonacci tool. So when you get this swing high, as I mentioned, all you require for a swing high is a previous bearish move. So you get a bearish move like this, and then price starts running up. So let's say we're running on buy side, or let me separate it with different colors. We're running on buy side, then we get a little bearish move, and then we continue on buy side. Once we get the buy side and then sell side from here, you know that we have a swing high, and you can just simply mark out from here and wait for it to pull back down into the discount. So once it pulls down into the discount, you're not just looking for the discount, you're looking for the golden zone where it usually continues from the discount, and you'll typically see around the 0.62, 0.705 is where it runs into before running higher. And most of the time you can also pair this with a fair value gap. But how do you know that the first time it starts running up is going to be the main move? Usually it isn't. Usually it sweeps out the low again. So how do you know? This right here is not when we're looking for a trade. We're looking for a trade the second time, when we create an order block, where we create an inversion for value gap, and we create regular for value gaps from the new move. Typically the first move is too weak and it doesn't actually create any of those. So then it sweeps out the low and then starts moving towards the true narrative and actually disrespects some gaps, actually creates some new gaps, and runs with enough volatility for you to catch your scalp entry. So 0.62 is one of the golden zones. Now, how can you use the projection tool? So one of the tools that you have as a trader is the Fibonacci projection. So we got -1 and -2. This will project above the range. So if you're taking a trade from a swing low to a swing high, and inside of the discount, you could typically project, if you're following the narrative, these are levels where you are like, okay, we just ran to the -1 standard deviation, we can close our position here. Typically this is just slightly higher than the previous, or like double the swing high that was created the first time. Because think about it, if you're trading with the trend, then you project how big this move is, and you expect it to either double the move or continue moving with the trend. So when we do run up to one of these levels, this is typically when we start seeing a new swing high form and it pulls back to continue higher, right? So when you're trading the Fibonacci, you can project the tool, and once it reaches -2 or -1, you use this as a confluence to exit your position and look for the next swing high, look for the next scalp. Swing traders, they enter the first time somewhere around here, and they try to just hold it with their stop loss in place. A scalper goes in with more risk and gets out of the market faster. So a scalper will get out at the -1 standard deviation, wait for the next swing high to form, get into another position, get out the high or the -1 standard deviation, and once again repeat the process. This is what you're doing as a scalper, so that you don't have to worry about all the consolidation. You don't have to worry about your position getting ran all the way back down to break even, and you actually walking away with nothing at the end of the day. A scalper is going to constantly take profits and walk away with something at the end of the day, no matter what. So that's your objective if you're trading with a Fibonacci. Macros aren't as perfect as you might think. So macros are the 20-minute periods where you're looking for highs and lows. So why aren't macros as perfect as you think? That's because just like accumulation, manipulation, distribution, there's 3 types of macros: the A macro, the M macro, and the D macro. So there are macros that accumulate, which means that once this window opens of 10:50 to 11:10, it will just consolidate. There are macros where there's manipulation macros. These are the ones that we're optimally aiming to trade, where there's a high and a low previous to the macro. Then we sweep out the high and we run on the low inside of this macro. And the third type of macro is the distribution macro. Once this macro opens, it distributes price in one singular direction. So, how do you know which one is which? This is how you kind of zoom out and really think about what a macro is. So why does the macro move during 10:50 to 11:10? Let me explain it to you. Or 11:50 to 12:10. What happens is typically the 1 hour time frame, every 4 hours, the 4 hour time frame closes. So if you really understand this, then when the 1 hour candle is closing, if there's a gap on the 1 hour time frame that it's aiming to close into above, like let me show you an example. Let's say we have a 1 hour candle right here, and we have, there you go, and we have a bullish gap or we have a bearish gap right here, right? So here's our 1 hour candle. The macro opens right here on the lower time frame. This is where the 1 hour candle is currently at. If the macro opens right here and we have a swing low on the 1 minute time frame, we sweep out the low. We know that there's a high right here, and right above this high is this 1 hour gap. This is 10:50. We have 10 minutes for it to run up here, sweep out the high, and close inside of this gap. So how's this going to look on the lower time frame? We're going to sweep out the low on the 1 minute time frame and use that volatility, use that liquidity to run up and close right here. So at 10:50, we got 10 minutes until the 1 hour candle closes. So the macro is going to pull down, sweep the low, and then the 1 hour candle is going to run up, try to close inside of this gap, because it's always drawing to the gaps on the 1 hour time frame. So let's say we sweep out the high, we run a little bit higher than this, and we end up taking out some 1 minute high, right? We take out some 1 minute high inside of the macro. This is where we get sell side. If we know that there's a 1 hour gap right here, and we just took out the high, the 1 hour candle is about to close because we got 10 minutes left. If it's up here at 10:50, then it takes out the high and it will run down and close right here. That's how macros work. So I'm not sure if I explained that good because I am super tired right now. It's like 12 a.m. It's also why I'm talking kind of quiet. But what I'm trying to teach you guys is that macros have a reason. Every 4 hours, you're supposed to pay attention to the 4 hour candle and think about, where is this 4 hour candle going to close? We got 20 minutes. We're trying to determine from 10:50 to 11. And then from 11 to 11:10, it's going to pull back down after. The next 1 hour candle opens. Where's the next 1 hour candle going to manipulate to before it runs up? So that's another thing. So when that 10:50 to 11, let me just show you some examples. Let's go back to the 1 minute time frame. So 4:50, this looks like it's going to consolidate because it wants to close somewhere around here. So 4:50 to 5:10. Oh, this is end of day. Whoopsies. Let's look at an example that's actually inside of a session. There you go. So here we have Asia range opening. So we got 750, boom. 750, we want to close this previous 1 hour candle. This right here is an indicator showing the 1 hour candle, by the way. So if right here, this is where our 1 hour candle is. It's a bearish 1 hour candle. So we're thinking about where does this 1 hour candle want to close? How does the body want to look on this 1 hour candle? So you see we pull 1050 and we're closing at or 7:50. I mean, 7:50. We're closing at 8, and then we got 10 minutes of the new candle. So we just opened a new 1 hour candle. If this new 1 hour candle wants to run towards buy side, then the first 10 minutes can run on sell side, create a wick, right? We're creating a wick, and then we can expand towards buy side with a wick. So you'll see that's exactly what happens here. We run down first in the first few minutes of this macro. We swept out this low. You see right here, we swept out the low. Let me show you because it's probably unclear for you guys. But we took out the low here. A wick was created on the 1 hour, and now we can expand towards buy side. Boom, bullish 1 hour candle. That's how it works. That's what macros do behind the scenes. It's basically just manipulation of 1 hour candle, or it's where the 1 hour candle, previous 1 hour candle wants to close, how the 1 hour candle wants to close. And in order to identify that, you're not just stuck on the 1 minute looking for a sweep of liquidity. You look at the 1 hour time frame and you're like, okay, are there any gaps here that I can reference? 1 hour time frame. We have a previous 1 hour candle that doesn't have a wick. That's an inefficiency. That's a huge inefficiency. You can see wherever we ran down below that, we ended up running higher from there. So that was your inefficiency for that day. Other times you're going to have a 1 hour fair value gap. You're going to have a 30-minute fair value gap. You can use those with macros to pair it to find the ultimate scalping strategy. When it taps into a 1 hour fair value gap, new 1 hour candle opens, and you know that this new 1 hour candle wants to run towards buy side. So you wait for it to run on sell side, and then you long from there. Hope you guys understand that, because it's a super complex way of trading, in terms of the fact that you're gonna have to literally lock in. You're gonna have to be so locked in, constantly observing the 1 hour while being on the 1 minute. One of the helpful things that I typically use is the split screen, so that I can view the 1 minute time frame right here while looking at the 1 hour time frame with macros. So if you're scalping, TradingView Premium is your best friend. This is not an ad. This is your chance to succeed with this. Really good scalping tool. And it's going to pay for itself. You get a funded account or you take a trade on your live account, it's going to pay for itself. Don't be shy to spend some money on tools that are actually going to help you see the important stuff in the market. Because most people, they stick to one time frame. They don't understand how trading even works. They don't understand these concepts that they're learning. Other people out there teach manipulation macros, and they're like, during this time, it's only going to sweep sell side, buy side. That's what you're looking for. But there's a reason behind it. The reason why it does that is because a new 1 hour candle opens in the last 10 minutes in the last 10 minutes, a 1 hour candle closes. In the first 10 minutes of the new hour, it typically manipulates to create a wick before the new 1 hour candle expands. So that's kind of a reason behind how macros work. Next, we have inversion for value gaps. So how do inversion for value gaps work? How can you use them? Once again, it's going to exist on every single time frame. We have an inversion for value gap right here on the 1 hour. This was during Friday with news, so we're not going to look at that one. We want to find an example that it actually referenced. So here we have an inversion for value gap. We have a bearish gap. It closed above this gap, came back into it, respected it. So when we close above a gap like this, then we can hop into the 1 hour candle, wait for it to tap into it or fill it up, and take scalp trades from the inversion for value gaps. So let's hop into the lower time frame here. Right, so here we have 9:50, where this 1 hour candle is coming to a close. The 1 hour candle closes above it at 10 o'clock. Here we have 10 o'clock. We got a new 1 hour candle. Then we tap into it. The next hour taps into it. There you go. So now we're expecting longs from this 1 hour IFEG. So on the lower time frame, we just wait for our entry model. This right here, by the way, is an order block because we did already take out the high of this range. We ran up on the high. So now we can take longs from this order block, secure stop loss below the gap, and target the highs. And booyah, would you look at that. TP hit. Why? Because we're using a higher time frame inversion for value gap. So we identified the higher time frame narrative, and on the lower time frame, we're just looking for that trade. Like I said, after the new 1 hour candle opens, it manipulates towards sell side. Here we got the manipulation towards sell side. Created the wick on the 1 hour time frame, which by the way, I don't have the 1 hour candle showing. Let me show you guys. 1 hour. There you go. You see when we opened the new 1 hour candle, we ran down right here, creating the wick right below the open. You see that? Created the wick right here into the IFEG on the 1 hour time frame, and that gave us confluence for price to run up higher. IFEGs are used like this. Once market comes up, closes above it, that's showing us that price wants to move higher. Here's another IFEG. We close above it, tap back into it, and move higher from it. So IFEGs are your favorite confirmation tool, favorite continuation tool to use to identify the narrative and trade the narrative. So I'm going to wrap up today's part of this video, which I believe was the longest because I got a whole bunch of backtesting, a whole bunch of explaining concepts. So I'll catch you guys in the next section of the video, which is probably going to be wrapping all of this up and forming your ultimate scalping strategy using all the concepts that I covered in this video. So I'll see you guys there. Okay, so let's quickly break down everything that we learned and formulate your strategy. So first things first, what did we learn in this video? The most important thing for scalping is, first of all, being able to separate scalping from swing trading scenarios. You're going to want to find that tie bound range on the weekly time frame, and obviously always use the higher time frame. So always use higher time frames, find scalping conditions, and in order to take a trade on the 1 minute time frame, you're going to want to first find a 1 hour time frame confluence, or you're going to want to find a 4 hour time frame or a daily gap that it's going to be running from. Find a HTF confluence that, or not confluence, let's do inefficiency that it's running from. Then that's when you scale down to the 1 minute time frame and you start looking for the entry criteria. What is your entry criteria? Your entry criteria is going to include premium / discount. Your entry criteria is going to include a new FVG. You're going to include a order block to form. And any of these inside of the discount gives you already enough of a confluence to enter the trade. What you're going to target is liquidity. What you can use to know when to take the trade, macros. Make sure it's inside of a session or a kill zone. And there you go. That's everything that you need to know to formulate the ultimate scalping strategy. You're going to want to use the higher time frames. You're going to want to find the scalping conditions. You want to make sure that it's going to be giving you entries on the lower time frame. It's not just massively expanding in one direction. That's when you should be swing trading and not scalping, which means that you're holding the trades for a longer period of time. You open up your stop loss. When it's super volatile and moving up and down, that's not when you want to be scalping. A lot of people think that when it's moving up and down, you can quickly hop in and out. No, when it's moving up and down, that's when you want to widen your stop loss and hold towards the trend, because you're not going to be able to scalp a super volatile environment. It's going to be super difficult. That's what a lot of people have mixed up. They think that when it's super choppy, they're like, oh, this is perfect scalping conditions. No, guys, when you want to actually have a basically one-sided direction market where you're able to catch trades that pull back into the discount and continue with the trend. When it's super, super choppy, that's when you start second guessing your scalping, because you're going to try to take a long. It's going to bounce off of like whatever zone it's consolidating in, and it's going to make you doubt your initial narrative, and you're going to switch up and it's going to do the same exact thing. That's when you blow your account. So make sure that you're scalping in scalping conditions and you're swing trading in swing trading conditions. So thank you all for sitting through this video. I'm going to make another video just like this on your ultimate swing trading strategy, and it's going to include some of the other things that you're going to need to know for swing trading. In that video, I'm also going to include the type of conditions that I would be swing trading in, which is also going to help you know better when you should not be scalping. So without further ado, thank you again for sitting through this entire video. If you've made it all the way through, be sure to let me know in the comments. Drop what you learned, what was the most important thing that you may have been missing from your strategy, and I'll catch you guys in the next video. Peace out.